Hey everyone. Today, thanks Mike. Hey everyone. Today we wanted to talk about a couple things that are in the Financial Post today, and there's two articles that got us thinking. The first is there's a couple surveys out that says Canada's economic growth is going to be pretty spectacular over the next 2 quarters. So to even think that that would be written about in January, February seems kind of shocking, but there it is. So a report's come out saying now that the economic growth in Canada, it was released by Merrill Lynch, and they're saying it's going to suggest that Canada is poised for a quarter or two of 10% growth. So there you have it. You know, we've been reading the doomsday stuff for a few months now. There's something totally on the other side. And then this article came out, and it's also in today's Financial Post. This is printed off the web, obviously. And it says, housing rebound nothing short of amazing. And it goes on to say that June, so last month, was up 8.7% from the previous month, and 7.9% higher than last June. So that is some big numbers. So June is basically one of the hottest Junes on record. And that kind of reflects stuff that we've been seeing in the market, especially in the starter home category. In June specifically, we lost, as a team here, a lot of deals to multiple offer situations. So those numbers, we can kind of see that on the streets. But here's what I want to talk to you about, is that, you know, in December, January, so about 6 months ago, we could read nothing positive in the news. Everybody was scared to buy anything. Everyone was scared to buy stocks in financial companies, and to even think about buying a real estate investment property was crazy. And then now here we are, 6 months later, and the economy is poised for great growth, and June was the hottest month ever, and if you owned property, you likely picked up some appreciation because of this stuff. And the point of all this is that you can't time the market. You can never time the market. All of this reminds me of a story we had a couple years ago with an older gentleman who came in to talk to us about some real estate investing strategies, and he shared that in the early 80s, he picked up, over the course of a couple of years, he picked up 15 properties, 15 different properties, and he held those properties, and I assume he still holds them, to when we were talking would have been 2007. So he had held those properties for what, I guess about 27 years. The mortgages were paid off. He was sitting on, I think he said it was something like $4 million in equity in those properties, something like that. And he was generating $15,000 to $17,000 a month in cash flow. So $15,000 to $17,000 a month in cash flow. Now here's the interesting part. He said that in the mid-'80s, everybody told him to sell the properties because the market was taking off and he should get out while the going was good. He ignored everybody and held the properties. In the early 90s, when the real estate market tanked, specifically in Ontario, when interest rates went up, there was 1 month in the early 90s, in 1 month interest rates went up almost 3%. GST came into effect and North American Free Trade came into effect. Real estate market went in the tank. Everybody told him to sell because the market was in the tank. He ignored them. He held the properties right through the 90s as they inched up. Then as the 2000s started to get rolling, real estate started to take off again. Everybody was now telling him to sell again, and he wanted to ignore them again, and he was telling me that he was ignoring them. He planned to pass this on and create some generational wealth in his family and pass these properties on to his kids, and they could pass it on to their kids. So, you know, he wasn't swayed by any, housing is hot, the economy's good, or 6 months ago the economy's bad. He brought an asset, figured out how to have it self-liquidating, or to have that property or that asset pay for itself, and held on to them as long as possible. Now he's sitting on, he was mentioning it was around about $4 or $5 million in asset free and clear, in equity that he was sitting on, and $15,000 to $17,000 a month in cash flow that he was generating. So, you know, never try to time the market, something we always try to remind ourselves of. And when you're thinking about buying property, something that you can remind yourself of as well, it's not timing the market, it's time in the market. Someone, I can't remember who shared that with us, but it's a great strategy. We're always trying to remind ourselves of something for you to think of. Never try to time the market. Find a good asset that is self-liquidating. What we mean by that is that it pays for itself, and then try to keep your assets in the market as long as possible. So don't time the market. It's time in the market that counts. That's it for today. We'll talk to you next time. Hopefully you found that useful. Talk to you soon.